Today, we're diving into a lineup of stocks with massive potential, companies poised for explosive growth in industries ranging from AI to digital finance to the rebuilding of Ukraine. Some of these names might be completely new to you, but trust me, they are worth watching. Let's get started. The first high-growth opportunity is Veon. The ticker is Veon. Veon is a global telecommunications powerhouse operating in emerging markets across Eastern Europe, Central Asia, and South Asia. This company isn't just providing basic mobile services, it's at the forefront of bringing digital transformation to underserved regions, offering mobile connectivity, broadband, and digital financial services through local brands. So why am I excited about Veon? Let's break it down. The first reason is its explosive growth in emerging markets. Veon is strategically focused on high-growth regions like Pakistan, Ukraine, and Bangladesh, where demand for mobile and digital services is skyrocketing. Unlike saturated Western markets, these regions are seeing millions of new users coming online every year, unlocking massive revenue potential. According to the GSMA Mobile Economy Report, mobile internet adoption in South Asia is projected to grow by over 300 million users by 2025. Veon's strong foothold in these regions puts it in the perfect position to capitalize on this surge in demand. Another big reason to consider is Kyivstar's potential Nasdaq listing. One of the most exciting developments for Veon is its plan to list its Ukrainian subsidiary, Kyivstar, on Nasdaq. Kyivstar is already the leading telecom provider in Ukraine, and this move could unlock major value for investors, offering direct exposure to a fast-growing telecom giant while boosting Veon's overall visibility and cash flow. This strategy has already caught the attention of major investors, and if successfully executed, it could significantly increase Veon's market valuation and bring in additional capital for future expansion. This is just the beginning. There are 3 more reasons why Veon is a potential breakout stock, plus one red flag investors need to watch closely. Stick around as we dive deeper into what makes this stock a compelling investment. Third reason is its crushing debt. Veon has been slashing its debt aggressively, strengthening its financial position. The company recently paid off a massive $805 million credit facility, cutting down interest expenses and improving its balance sheet. Lower debt means lower financial risk, and for investors, that's a big green flag. A leaner, debt-free Veon is a more competitive Veon, giving it the flexibility to invest in expansion and digital transformation without being weighed down by costly liabilities. Next reason to consider Veon is its digital powerhouse. Veon isn't just another telecom company, it's rapidly evolving into a fully-fledged digital services provider. The company is leveraging AI-powered platforms like Jazz Cash and Handy, expanding beyond mobile plans into fintech and digital services. This strategy future-proofs Veon, allowing it to generate multiple revenue streams while reducing its reliance on traditional telecom services. With digital adoption soaring in emerging markets, Veon's move into AI-driven mobile banking and e-commerce services puts it in an excellent position for long-term growth. Fifth reason is its stock buybacks bonanza. When a company buys back its shares, it's often a signal that management believes the stock is undervalued, and that's exactly what's happening with Veon. The company recently launched a $30 million share buyback program, demonstrating confidence in its financial health and long-term prospects. Insider confidence is usually a good sign for investors, as it shows the people running the company are betting on themselves, and that's something worth paying attention to. You might be wondering, what's the red flag for this stock? Well, the biggest red flag in the case of Veon is tech lag that could slow down the growth. Now, before you rush to invest, there's one big risk to consider. Veon is still heavily reliant on 4th-generation networks in markets that have been slow to adopt 5th-generation technology. If the company doesn't ramp up its network upgrades fast enough, it could find itself trailing behind competitors that are already pushing into 5th generation and beyond. Falling behind the tech curve could limit growth potential and impact its ability to compete in the evolving telecom landscape. The next stock is OppFi. OppFi is a fintech powerhouse revolutionizing access to credit for underserved consumers. Millions of Americans struggle with low credit scores, making it difficult to secure traditional loans. That's where OppFi steps in. The company uses AI-driven risk assessment to provide installment loans that serve as a lower-cost alternative to payday lending. With a focus on financial inclusion, OppFi is bridging the credit gap for millions of people who traditional banks might otherwise overlook. Now let's break down why this stock is catching my attention, and at the end, I'll share one key red flag to watch out for. First reason is its profitable fintech powerhouse. OppFi is not just growing, it's making serious money. In the third quarter of 2024, the company reported record-breaking net income, proving it has a sustainable and profitable business model. Unlike many fintech startups that burn through cash to chase growth, OppFi has found a way to scale while staying profitable, a key factor in long-term stock performance. And here's a stat that will blow your mind. According to a McKinsey & Company report, the global fintech market is projected to reach $324 billion by 2026, growing at a 25% annual rate. With its unique approach, OppFi is well positioned to carve out a significant piece of this multi-billion-dollar market. The second big reason to consider OppFi is its small-cap stock with big-cap potential. Right now, OppFi is sitting at a market cap of around $1 billion, classifying it as a small-cap stock. But here's the thing. Small caps like this have huge room for growth. Historically, small-cap stocks have outperformed large caps during economic recoveries. According to data from Bank of America, small caps tend to deliver higher returns than the S&P 500 when markets rebound from downturns. With increasing investor confidence and growing institutional interest, OppFi could be on the verge of a major breakout in 2025. The third reason is the AI edge in digital lending. Artificial intelligence is changing the game in financial services, and OppFi is leading the charge. By integrating AI and advanced analytics into its lending platform, the company can assess risk with greater accuracy, reducing defaults while expanding access to affordable credit. A recent report from PwC predicts that AI will add $15.7 trillion to the global economy by 2030, and financial services will be one of the biggest beneficiaries. Companies that harness AI to improve efficiency and decision-making will have a major competitive edge, and OppFi is already ahead of the curve. By automating loan approvals and reducing operational costs, OppFi can serve more customers at a lower price, improving both profitability and scalability. The next reason to consider OppFi is its trading. Even after a staggering 240% surge over the past year, analysts still see OppFi trading below its fair value. This isn't just hype. The company's fundamentals remain strong, with a solid price-to-earnings ratio and a healthy current ratio, indicating it has enough liquidity to cover short-term obligations. This is what value investors dream of, a stock that's already winning but still flying under Wall Street's radar. It's a classic value play where buying in before the market fully realizes the company's true worth could lead to major gains down the road. The next big reason is OppFi being consistently crushing earnings expectations. OppFi has been on fire when it comes to earnings surprises. In its latest report, the company posted earnings per share of 33 cents, completely smashing the 21 cents forecast, a beat of over 50%. And it's not a one-time fluke. Analysts predict that OppFi is on track for over 80% earnings growth through 2025. Historically, stocks that consistently outperform analyst expectations tend to attract more institutional investment, pushing share prices higher. If OppFi continues delivering strong quarterly reports, this stock could become a long-term portfolio staple for growth-focused investors. Now, let's talk about the biggest risk factor for OppFi, its debt load. While the company is growing fast, it's also carrying a notable amount of leverage, which could become a problem if interest rates rise or growth slows down. For a small-cap stock, too much debt can be a double-edged sword. It fuels expansion but can also create financial strain if economic conditions change. That's why it's crucial to keep an eye on their balance sheet and ensure that OppFi isn't overextending itself. The next stock on my watch list is Credo Technology, ticker CRDO, a semiconductor company specializing in high-speed connectivity solutions. It's a key player in data centers, telecommunications, and networking infrastructure, helping power the future of fast data transfers. Now let's talk about Credo Technology, a company that's making waves in the AI and data center space. Their cutting-edge connectivity solutions are becoming critical infrastructure for the AI revolution. And the numbers don't lie. This stock has been on a massive growth trajectory. But before we break down the reasons why Credo could be a game-changer, stick around because I'll also be covering one major red flag that investors need to watch. The first big reason is the explosion of AI-powered data centers, which is fueling skyrocketing demand for Credo's high-speed connectivity solutions. From active electrical cables to optical DSPs, their technology is built to handle the surge in AI-driven data traffic. And the proof? Their latest quarterly revenue hit $72 million, marking an insane 64% year-over-year growth. with AI infrastructure spending expected to reach $1.5 trillion by 2030, according to Bloomberg Intelligence. Companies like Credo that provide the backbone for AI computing are in an incredible position to benefit. The second reason to consider Credo is its outpacing market forecasts at an unbelievable rate. Their last earnings report shattered expectations, and their next quarter guidance suggests revenue could climb to $115 to $125 million, a jaw-dropping 67% increase. For investors, this kind of consistent outperformance signals strong execution, demand, and future upside. When a company keeps crushing analyst predictions, institutions start taking notice, and that means more money flowing into the stock. The next reason is its power efficiency. Data centers are power-hungry giants, and with AI workloads requiring massive computing power, energy efficiency has become a top priority. Credo is leading the charge with its 800 gig zero-flap cables and power-efficient interconnect solutions, helping companies like Microsoft cut costs while boosting performance. With the world becoming more energy conscious and AI adoption growing exponentially, Credo's technology is solving a critical problem, keeping power consumption low while ensuring blazing fast data speeds. That's a winning formula for long-term demand. Next is exceeding its growth expectations. When Wall Street analysts overwhelmingly back a stock, it's worth paying attention. Credo currently has a strong buy rating, with price targets ranging from $81 to $90, which means analysts see a solid 15 to 25% upside from current levels. Institutional investors tend to follow analyst sentiment, and as Credo continues to exceed growth expectations, we could see even higher targets in the near future. Another reason for choosing Credo is its profit margins that are set to soar. Credo isn't just growing revenue, it's on track to boost its profit margins significantly. As their product mix shifts toward higher value solutions like AECs, analysts predict that earnings per share could hit 59 cents by 2026. For a stock that's already gaining momentum, rising margins mean even more cash flow, which could fuel future growth, acquisitions, or even stock buybacks, all positive signs for long-term investors. But what's the red flag for Credo? Now, before you rush to hit that buy button, there's one big risk to consider. Credo relies heavily on a single customer. Right now, Microsoft accounts for over 33% of Credo's revenue, making it a high-risk play if that partnership slows down or falls apart. If Microsoft shifts suppliers, delays orders, or negotiates lower pricing, it could seriously impact Credo's growth trajectory. This kind of customer concentration is always a risk, and while Credo is expanding, diversifying its customer base will be key to long-term stability. Moving on to the next big stock on my radar, let's talk about Uber. You already know Uber as the world's largest ride-sharing platform, but what you might not know is just how much growth potential this company still has. First reason is the undisputed ride-sharing king. Uber's massive global network of drivers and riders gives it a competitive moat that's nearly impossible to replicate. In the third quarter of 2024 alone, Uber facilitated almost 2.9 billion trips, a staggering figure that highlights its dominance in the space. More trips mean more revenue, and Uber's scale gives it pricing power and operational efficiency that smaller competitors simply can't match. Second reason is a cash-generating machine. After years of burning cash, Uber is finally turning a profit, and not just a small one. The company is projected to generate $6.5 billion in free cash flow for 2024, climbing to $7.7 billion in 2025. This shift from a high-growth, money-losing startup to a profitable industry leader is a game-changer, making Uber a mature, cash-rich stock with room for long-term investor rewards. The third reason is its revenue growth, which is booming. Uber isn't just maintaining its position, it's still growing fast. Analysts are forecasting a 15.7% revenue jump in 2025, fueled by continued expansion in ride-sharing, food delivery through Uber Eats and its freight business. While many tech stocks have seen growth slow, Uber's ability to outpace the broader market makes it a strong contender for future gains. Another reason is a bargain price for a growth giant. Despite its dominance and profitability, Uber's stock is still relatively cheap. It's currently trading at just 17 times next year's expected free cash flow, making it an attractive value play for a growth machine of this scale. Wall Street analysts have an average price target of $91 to $93 per share, suggesting a solid upside from current levels. The next reason is future-proofing with robo-taxis. Uber is already thinking ahead and making strategic partnerships in the autonomous driving space. By collaborating with companies like Waymo, Uber is positioning itself to integrate self-driving technology into its platform without taking on the full cost of development. Instead of being disrupted by autonomous taxis, Uber could actually benefit by incorporating them into its network, turning a potential threat into a major competitive advantage. The red flag is, will self-driving tech kill Uber? The biggest concern for Uber is the rise of fully autonomous vehicles. If companies like Tesla or Waymo manage to create an end-to-end self-driving ride-hailing service, it could bypass Uber's platform entirely, cutting the company out of the equation. While Uber's partnerships help hedge against this risk, the uncertainty over who will dominate the autonomous future keeps some investors cautious. Next up, we have Celestica, a company that's quietly positioning itself as a key player in AI, cloud computing, and semiconductor manufacturing. Celestica provides design, engineering, and manufacturing solutions across industries like aerospace, defense, healthcare, and data centers. Their ability to streamline production and accelerate product innovation makes them an essential partner for some of the biggest names in tech. First reason is AI, which results in its explosive growth. Celestica is benefiting directly from the surging demand for AI infrastructure. Their connectivity and cloud solutions segment saw a 42% revenue increase last quarter, driven by the need for AI-driven networking and computing solutions. With companies ramping up AI investments, Celestica is positioned to be a critical supplier in this transformation, and that's why their growth is accelerating at such a rapid pace. Second reason is its past earnings and expectations. Celestica isn't just growing, it's outperforming consistently. Over the past 4 quarters, the company has beaten earnings estimates by an average of 12.2%. And their latest Q4 2024 adjusted EPS of $1.11 crushed forecasts. When a company consistently delivers better than expected results, it signals strong execution and increasing demand. 2 things every investor loves to see. Third reason is its future growth. Celestica just raised its 2025 guidance, now expecting $10.7 billion in revenue and an adjusted EPS of $4.75. Up from their previous forecast of $10.4 billion and $4.42 EPS. This revision proves that demand is strong, especially from hyperscale customers, and that growth isn't slowing down anytime soon. Next reason for considering Celestica as one of the best stocks is its major wins for securing future growth. Celestica recently secured a major AI-optimized rack system program with a top-tier digital company set to roll out in 2026. By leveraging its R&D, Celestica is locking in high-margin, long-term revenue streams in some of the fastest-growing tech sectors. This isn't just a short-term win, it's a sign of lasting industry leadership. Now, before you get too excited, there's one important risk to keep in mind. Celestica is trading at a premium. The stock is currently priced 28% above its industry peers on a forward earnings basis, meaning growth expectations are already baked into the price. If tech stocks cool off or if growth slows down, Celestica's valuation could limit upside potential, so watching for a better entry point might be a smart move. These companies are at the center of the biggest tech trends of our time, from AI and data centers to digital finance and cloud computing. But as always, due diligence is key. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, Central Bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide.